Hello and welcome to our recap of IAS 8. Don't forget that you can download all of our mind maps for free on the website as a PDF, or indeed you can buy the full course on which this recap is based should you wish to do so. So this is looking at accounting policies, estimates and errors. So accounting policies, first of all. What are we talking about with accounting policies? Well, remember, this is our principles, the basis, the conventions, i.e. the rules on our financial statements. These will be set out in the IFRS. So these are going to be set out in the IFRS. So they're appropriate if they are going to be relevant to the users, if they're going to give a true and fair view. They also need to be neutral and complete, and they need to be prudent. So what they need to do is all of those things. So if we're thinking about changing our accounting policies, well, if these rules are set out by the IFRS, we'll only change them if required by IFRS. Theoretically, we could change them if it was a more relevant thing to do, but that's going to be very rare. Generally, changes will be if required by IFRS. So we'll change them when there is a change in recognition, presentation or measurement. So if you're trying to decide if it's a change in accounting policy, check whether it's a change in recognition, presentation or measurement of something. If so, that is a change in accounting policy. The treatment for that will be we need to do it retrospectively. So what we need to do is we need to change the opening balance on our reserves, and we need to change the comparatives for last year. We need to restate last year's comparatives for a change in accounting policy so that we can compare last year to this year. Accounting estimates, well, they're slightly different. Here we're thinking about a method required to arrive at an estimate. So for example, we said the useful life of an asset or the residual value of an asset. That would affect the depreciation rate or the estimate of a provision. All of those are accounting estimates, not accounting policies. They're not set out in stone in a standard. The accountant has some judgment to make on these. So accounting estimates are things that the accountant must make a judgment on. So the importance of this is that they have to use that judgment. These have to be based on the best information we have available, but be aware that they may change if that information changes. So if we're changing an accounting estimate, remember, we'll do this in the income statement, but we'll do it in the period of change. So it's not retrospective, it's prospective, only moving forward. It's classified in the same place and disclosed if material. So simply for an accounting estimate, we will disclose it and do it moving forward. So one of the key things here is we need to be able to decide between whether something is an accounting policy or an accounting estimate. So ask yourself, is it a change in accounting recognition, measurement or presentation? So if we're changing the recognition, measurement or presentation of something in the financial statements, that will be a change in accounting policy. If the accounting is using judgment or we're not changing any of those three things, it'll be an accounting estimate. And we looked at an illustration of how to do that in illustration 1. We then went on to look at prior period errors. Remember, these are simply mistakes that have been made in prior years. Why might that happen? Well, simply through mathematical error or the use of the available information was done incorrectly. So these should not have happened. How are we going to deal with them? Well, what we're going to do is adjust the balance to correct the error. We'll do that at the start of the new year. So we found the error last year. We're going to have to adjust the balance to correct the error at the start of this new year. That will mean that we need to adjust the reserves brought forward. So we do that and we restate the comparatives so that we've adjusted completely for the error. We did a detailed example of that in illustration 2. Disclosures on this, well, when we've done this, we need to disclose a current year statement of financial position. We also need to disclose a new statement of financial position for the prior year, both at the start of the prior year and at the end of the prior year. So we need to disclose 3 statement of financial positions. So do be aware of that. The last thing we looked at was regulation. That's important for accounting policies because remember, accounting policies will be set under IFRS. So the regulation will be IFRS. It's set by the IASB, the International Accounting Standards Board, and their objective is to develop international standards to ensure comparability and to make financial statements understandable to the users. So do be aware that those are the objectives. There are some problems that the IASB tries to overcome. For example, they need national cooperation. Each individual country needs to choose to implement the international standards. And we need international convergence between accounting standards, particularly between international standards and US GAAP, i.e. the general accounting principles that they use in America. So we need to make those convergent. So that was a recap of our lecture on IAS 8.